Meantime, St. Louis Fed President James Bullard is saying that he believes interest rate hikes and the balance sheet reduction will likely be coming to an end in 2019. His recent comments coming after the FOMC January minutes gave investors some insight regarding their monetary policy and thought process for 2019. Joining us now, Stanford School of Business lecturer in management, Dave Dodson. Dave, your thoughts on the minutes yesterday?
Yeah, well, I was looking at them, and my take on it was that the Fed didn't blink, the Fed caved. What is the difference between the economy today versus a month and a half ago? Unemployment and inflation is still at an all-time low. The only difference is that the White House and the markets complained. And so the Fed said, okay, no mas. But that's not the Fed's job. Now, you could say, okay, who cares? The market's going fine, let the good times roll. Here's the problem, and here's what we need to be worried about, is first, the Fed has two levers to pull when we have an emergency like we had in 2008. One is to drop interest rates. Well, they can't really drop interest rates because interest rates are already at historical lows. And the second is flood the market with liquidity. Now, they are trying to fix that. But the Fed is taking away its tools. It's as if they shot all their bullets in 2008, and during these good times, they haven't bothered to reload the gun. That's the first problem. The second thing is that these low interest rates that have gone on for so long have fueled a debt binge in this country that we have never seen before. A public debt binge, a corporate debt binge, and a personal debt binge. And that bomb is going to explode at some point when interest rates do have to come back up.
You know, Dave, it's interesting because we had the same conversation yesterday with David Stockman, and he was saying that this is going to implode as well. And my point was, you could argue that the president sort of just, this is musical chairs, right? And he's sort of stuck in a really difficult position, a position that he inherited here. As you mentioned, those two levers that the Fed was able to pull, it pulled them after the financial crisis. And now anybody would have a hard time dialing it back.
Well, not necessarily. When you have good times like we've had for at least the last half dozen years, that is the time you bring interest rates back up. And we look at the growth rate that we've had. It's actually not been bad from a global standpoint.
Was the economy really so great over the last decade or so? Or was it the policies that drove the markets higher? Was it inflated? Was it not real?
Oh, I think it's been inflated, but I think it's been inflated by debt. Look, people are buying stuff. That's what drives the growth rate. But they've been buying stuff by borrowing money. And the numbers are crystal clear if you look at consumer debt. And when you have an economy that's been fueled by just debt alone, that's going to have to come to an end, as Stockman said.
Well, the Fed caving, to your point, certainly, you know, the reaction by the markets in December of last year was not positive, and that's when it changed its course. You know, maybe it doesn't cave. Maybe we do get a hike or two later in the year.
Well, I think it would be good because I really do worry that the Fed doesn't have any ammo in their gun, as I said before. And so if the Fed does end up raising the rates a little bit this year, maybe once or twice, I think that'll be good for the long-term health. Because, of course, in 2020, it's going to be very hard for the Fed to be doing a lot of rate raising. It's an election year, and the fact of the matter is that does matter.
It does matter. That's right. And Federal Reserve Chairman Jay Powell, he also weighed in on the central bank's plans for the balance sheet back in January. Let's take a listen to this.
The decision to retain our current operating procedure means that, after allowing for currency in circulation, the ultimate size of our balance sheet will be driven principally by financial institutions' demand for reserves, plus a buffer, so that fluctuations in reserve demand do not require us to make frequent, sizable market interventions.
All right, so Dave, they're unwinding the balance sheet. They're doing it slowly with a deadline, and it's the balance sheet is still large enough to make investors feel comfortable that all of this is not going to collapse.
Yeah, and I think it's been great what they've done. $50 billion month after month after month that they've taken out of the liquidity in the market, and that's given us certainty. And they did signal in those notes that were released that they were going to continue to do that to the end of 2019. And that's the kind of visibility that actually investors like to have and the markets need to have. So that's been great, I think.
All right, Dave Dodson, great to see you. Thanks so much.
Likewise.